Hello, everyone. In the last lesson, we learned about the meaning and evolution of credit, understanding that credit is a trust-based lending activity that changes along with economic development. In a modern economy, credit takes many forms, and its characteristics and functions vary across different contexts. Today, we will systematically study the forms of credit and examine the specific types of credit that exist in real life. In this lesson, we will cover the following topics. 1. Commercial credit, direct lending between enterprises. 2. Bank credit, intermediated lending through financial institutions. 3. Sovereign credit, government borrowing activities. 4. Consumer credit, lending aimed at individuals for consumption. 5. International credit, cross-border lending activities. 1. Commercial credit, direct lending between enterprises. The first common form of credit is commercial credit, which refers to the credit provided between enterprises during the course of goods transactions, such as through trade credit or advance payment. For example, when a clothing factory purchases fabric from a textile mill, the textile mill may allow the clothing factory to take the goods first and pay 1 month later. This is commercial credit in the form of trade credit. Conversely, if a retailer pays the wholesaler in advance and receives the goods 1 month later, this is advance payment credit. The characteristics of commercial credit are quite clear. It occurs directly between enterprises and serves as an important form of short-term financing for businesses. The credit is typically tied to goods, such as fabric or equipment, and is closely linked to specific production and operational activities. The term is usually short, often 3 to 6 months, mainly addressing the temporary working capital needs of businesses. Commercial credit forms the foundation of the modern credit system, as it directly supports production and circulation of goods. However, its scale is limited by the financial strength of the enterprises themselves, making it difficult to meet large-scale financing needs. 2. Bank credit, intermediated lending through financial institutions. The second core form of credit is bank credit, which refers to credit provided in monetary form by banks or other financial institutions to enterprises or individuals. For example, a company applies for a working capital loan from a bank to purchase raw materials. An individual applies for a mortgage loan from a bank. Both cases fall under bank credit. The operational logic of bank credit is as follows. Financial institutions pool funds by collecting savings from residents, corporate deposits, and other sources, and then lend these funds to borrowers in need, acting as credit intermediaries. Compared with commercial credit, bank credit has 3 significant advantages. Wide scope, it serves not only enterprises but also individuals and governments. Large scale, banks aggregate large amounts of idle social funds, meeting the demand for large-scale financing. High flexibility, loan terms can vary from a few months to several decades, accommodating different financing scenarios. Bank credit is the main form of credit in the modern economy, overcoming the limitations of commercial credit and serving as a core link connecting supply and demand for funds in society. 3. Sovereign credit, government borrowing activities. The third important form of credit is sovereign credit, which refers to borrowing activities conducted by the state or government, mainly through the issuance of government bonds to raise funds. For example, the government bonds issued by our country are a typical form of sovereign credit. The government issues bonds to residents, enterprises, or foreign governments, promising to repay the principal and pay interest after a certain period. These funds are usually used for large-scale national infrastructure projects, such as high-speed rail or water conservancy projects, to cover fiscal deficits, or to respond to emergencies, such as natural disasters. The characteristics of sovereign credit are particularly prominent. High credit rating. Repayment is guaranteed by national fiscal revenue, making default risk extremely low. Hence, government bonds are often called gilt-edged bonds. Long-term, many government bonds have terms exceeding 10 years, meeting the funding needs of long-term projects. Strong regulatory function. The government can adjust the total amount of social funds by issuing or redeeming bonds, making sovereign credit an important tool for macroeconomic regulation. 4. Consumer credit, lending aimed at individuals for consumption. The fourth form, which is closely related to our daily lives, is consumer credit, referring to credit provided by financial institutions or businesses to individuals for consumption purposes. Common forms of consumer credit include installment payments. For example, when buying a smartphone, the seller allows payment over 12 installments, with a fixed amount due each month. Consumer loans. For example, individuals apply to banks for home renovation loans or travel loans. Credit card overdraft. Cardholders can spend within their credit limit and repay the balance by the due date. The core role of consumer credit is to release consumption demand in advance, enabling people to purchase high-value goods such as homes and cars even when their current income is insufficient, while also promoting sales and economic growth. However, it is important to note that individuals should use consumer credit within their means and avoid excessive indebtedness. 5. International credit, cross-border lending activities. The final form is international credit, which refers to credit activities between entities in different countries, including intergovernmental lending and loans provided by international financial institutions. For example, the World Bank provides low-interest loans to developing countries for poverty alleviation projects. Domestic enterprises apply for USD-denominated loans from foreign banks to finance overseas investments. Both are forms of international credit. Main forms of international credit include international commercial loans, enterprises or governments borrowing from foreign banks. International bonds, governments or enterprises issuing foreign currency bonds in international markets, such as USD or EUR bonds. International aid, grants or concessional loans provided by developed countries or international organizations to developing countries. International credit is an important pillar of global economic integration. It promotes the cross-border flow of capital, helps countries fill funding gaps, and facilitates international cooperation. Today, we learned about 5 main forms of credit: commercial credit between enterprises, bank credit intermediated by financial institutions, sovereign credit led by governments, consumer credit aimed at individuals, and international credit that operates across national borders. Each form has its own characteristics and they complement one another. Commercial credit supports short-term business operations, bank credit connects the supply and demand of funds in society, sovereign credit underpins macroeconomic development, consumer credit releases individual demand, and international credit promotes the global flow of capital. Together, they constitute the modern credit system, supporting the functioning and development of the economy. Understanding these forms of credit helps us better interpret real-world economic phenomena, for example, why enterprises need bank loans and the significance of government bond issuance. That concludes today's lesson.